Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Signature CIO Income Fund from Standard Chartered. This video is done as a follow-up request from a viewer's comment in my previous video covering the Fullerton Sing Dollar Cash Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Standard Chartered was formed in 1969 from the merger of Standard Bank of British South Africa and Chartered Bank of India, Australia and China. Given its legacy, Standard Chartered has a rather peculiar setup. Its shares are primarily listed in London and secondary listed in Hong Kong, reflecting the origins of the firm. Its official headquarters is in UK. However, it does not offer retail banking in UK and instead has the bulk of business and employees in Asia, Africa, and Middle East. Its largest shareholder is Temasek Holdings, a sovereign wealth of Singapore. In fact, Singapore's MAS has identified Standard Chartered as the one and only significantly rooted foreign bank, or SRFB, in 2020, which gives it enhanced privileges in Singapore that is almost as good as local banks. Standard Chartered slices its business into three parts: wealth and retail banking, corporate and investment banking, and SC Ventures. The product covered in this video falls under the wealth and retail banking business and is offered across client segments from retail priority to private banking. Standard Chartered, however, does not have an asset management business. Therefore, it has decided to partner with a fund provider to launch this fund product. The fund provider partner in this case is Amundi. Amundi is a French asset management company founded in 2010 from the merger of the asset management businesses of Crédit Agricole and SocGen, two of the leading financial institutions in France. Crédit Agricole has 80% ownership of Amundi, while SocGen has 20%. Amundi IPO'd in 2015 in the Paris Euronext and has been growing strongly through organic business growth as well as multiple acquisitions. Today, Amundi manages over 2.2 trillion euro worth of assets, making it the largest asset manager in Europe. Amundi's businesses are well diversified. Client base covers the full spectrum from retail and private banking through third-party distributors, to insurers, to sovereigns and institutional. Europe, with France in particular, obviously covers the bulk of the business, though Amundi has been relatively successful in Asia with about 21% of AUM from the region. Product diversification-wise, about half are active managed products. I'm not sure though whether this product falls under the joint venture segment or the multi-assets segment. Given the partnership arrangement, the Signature CIO Income Fund is a sub-fund under the Amundi Asia Funds fund family. Amundi Asia Funds is set up as a Luxembourg FCP company structure and is UCITS qualified. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. It should be noted that Amundi did not create this fund family exclusively for Standard Chartered. The prospectus currently covers 6 sub-funds. The first 5 are the Signature CIO funds for Standard Chartered, while the 6th is another fund created in partnership with DBS. Among the 5 Signature CIO funds, only the first 4 are registered as MAS recognized schemes to be offered to Singapore investors. It is likely this fund list will grow as Amundi finds more partnerships with other banks that do not have asset management business but would also like to create similar fund products. It is also important to note that from a legal perspective, Amundi is the investment manager of the fund, while Standard Chartered is only the investment advisor of the fund. Therefore, as an investor, you are technically subscribing to a mutual fund owned and managed by Amundi. What this means is that Standard Chartered is responsible for the investment aspects of the fund, such as investment objectives and strategy, determining and adjusting the portfolio, determining the distribution policy, etc. While amundi is responsible for the operational aspects of the fund, such as implementing the actual portfolio in accordance to the instructions given by Standard Chartered, calculating NAV and processing subscriptions and redemptions and distributions payouts, and handling corporate actions and regulatory documents, etc. One important thing to note is that the partnership arrangement should typically ensure the Signature CIO products are offered only exclusively by Standard Chartered and not transferable to other distributors. Before going into the fund strategy, I'm spending a quick few minutes to do a 101 on Discretionary Portfolio Mandates or DPM, as this is the essence of the Signature CIO funds. A DPM is essentially an investment service for investors who prefer to delegate investment decisions. This is like going into a Japanese restaurant that offers a wide variety of food, but you'd rather just pick one of the 3 omakase lunch sets and leave it to the chef to decide what dishes to prepare for you. In the investments world, standard DPM offerings is usually offered to private banking clients for a predefined minimum investment amount, and typically come in a few variations according to the client's risk profile. Some offer additional standardized offerings for specific objectives, such as income generation or regional biases. For clients with larger investment capital, the DPM offerings can be further customized according to specific client requirements. The bank determines the asset allocation and the investment products based on the mandate requirements and on behalf of the clients. The same resulting portfolio is applied to all clients who subscribe to the same discretionary portfolio. Discretionary portfolios were traditionally set up as segregated mandates, which means each client opens a dedicated account for the mandate, and therefore each account is still unique to the client, as the accounts are open on different dates, and the actual implementation of the investments can lead to small differences. Clients also directly own the respective investments in the account. However, converting DPM into mutual fund structure has been gaining popularity. While there are clients who still prefer to have their own distinct mandate in their segregated accounts and can therefore remain in the traditional DPM setup, banks are now also offering the standard DPM solutions in mutual fund structures for various reasons. To clients, mutual fund structure can easily provide lower investment amount requirements, making it easier to access. Falling under mutual fund regulations also mean clients get better data transparency and consistent updates via standardized fund documents. To the banks, running the DPM solutions in mutual fund structure is operationally easier compared to handling numerous individual client accounts. Also importantly, with the mutual fund structure, it becomes a lot easier for banks to extend the offering to retail client segment. The Signature CIO funds are created exactly for this purpose, and we will go through the details next. The Standard Chartered's Signature CIO funds essentially covers 2 aspects. The first is that it allows investors to access to Standard Chartered's CIO views through an investable product. The second is that this product is implemented as multi-asset portfolios and invested via mutual funds and ETFs. So there are no direct stocks and bonds found in the Signature CIO funds. You can also think of these products as fund of funds solutions. The CIO views are basically macro views of the global markets and economies via both quantitative and qualitative review, which translates to an asset allocation framework. The asset allocation framework comprises of a longer-term view called Strategic Asset Allocation or SAA, which is supposed to mean the most optimal asset allocation for the next 7 years, and blended with a shorter-term view called Tactical Asset Allocation or TAA, which is supposed to provide small overweight or underweight tilts in the SAA that should derive tactical or opportunistic benefits within the next 6 to 12 months. Standard Chartered's CIO team uses what they call a 3D investment philosophy, which essentially integrates external research views and also that the SAA and TAA are determined through team voting instead of being decided by the team leads or subject matter experts. The CIO team is headed by Steve Price, who is the Global Chief Investment Officer of the firm and is based in Singapore. I can't find details of the CIO team on the web, so I'm not sure how big is the team and how are the roles and responsibilities defined with regards to the contribution to the Signature CIO funds. Given the Signature CIO funds are essentially discretionary portfolio solutions, Daniel Farrell, Group Head of Discretionary Portfolio Management and Asset Allocation, is also responsible for this product range. Daniel reports to Steve as the in-house DPM business falls under the CIO team in Standard Chartered's organization structure. The Signature CIO funds currently come in 4 versions as seen here. The lowest risk profile version is called Conservative Fund. As seen in the sample asset allocation breakdown, the portfolio is mainly in bonds and cash equivalents. The medium risk profile version is called Balanced Fund. As seen in the sample asset allocation breakdown, the portfolio is roughly a 60% equities, 40% bonds allocation. The highest risk profile version is called Growth Fund. As seen in the sample asset allocation breakdown, the portfolio is roughly 80% equities, 20% bonds allocation. Finally, there is the Income Fund, which is specifically designed for income generation. It has a sample asset allocation breakdown of around 40% equities, 60% bonds, which sits in between the Conservative Fund and the Balanced Fund. This is the fund that we will be focusing on in this video. So far, what we have covered from SAA to TAA to deriving a range of model portfolios by different risk profiles and by specific investment objectives such as income generation is the typical approach for standardized DPMs in most banks. Next is the actual implementation. For segregated mandates and with larger investment amounts, it is possible to implement with direct stocks and bonds into the portfolio. However, with smaller minimum investment amounts and with a mutual fund structure, it is more efficient to implement with funds and ETFs, which is what the Signature CIO funds are doing. The SAA and TAA are updated and rebalanced in the funds on a quarterly basis. Standard Chartered markets the Signature CIO funds as so-called foundation portfolios, meaning they are meant to be used as the long-term core positions within clients' investment portfolios. Referencing the SAA and TAA, another team called Fund Select Team is responsible for selecting the relevant mutual funds and ETFs to be implemented into the Signature CIO funds. The Fund Select Team has a nice graphic summarizing their fund selection process, which covers screening to evaluating with a proprietary scoring methodology to periodic reviewing. The source link points to a blog article that elaborates the process a bit more for those who are interested. It is difficult to find details on the Fund Select Team members as Standard Chartered doesn't seem to provide information in its website. Based on Googling, Arthur Wu looks to be heading the Fund Select Team and the team falls under Danny Dubasque, who is the group head covering funds, alternative products, and wealth solutions. Again, I'm not sure how big is the Fund Select team currently and how are the roles and responsibilities defined with regards to the contribution to the Signature CIO funds. Now that we have gone through an overview of the Signature CIO funds, let's focus on the Signature CIO Income Fund specifically. The fund fact sheet provides a 2-paragraph investment objective and strategy summary. The main objective of the fund is to generate regular income via a global diversified portfolio with underlying positions focusing on income generation as well. This is repeated again at the end of the second paragraph. There is a secondary objective to generate capital appreciation over a mid to long-term investment horizon. Now this appears to rely on the basis that global equities and bonds in general do appreciate in value in the long run. So there is no deliberate effort to make specific investment strategies to improve the likelihood of capital appreciation. As with most income-focused funds in the market, I wouldn't expect much of this secondary objective. The second paragraph mainly talks about what is the Signature CIO strategy in general, covering the broad responsibilities of Amundi and Standard Chartered teams. To understand more about the fund, we will need to look at further details in the fund prospectus. The prospectus clearly indicates this product is a fund of funds that invest in other mutual funds and ETFs that are broadly covered under the UCITS funds and UCI's terminologies. There are limitations defined for asset allocation in the fund. The fund is allowed to have between 30% to 80% in fixed income, of which up to 60% can be in high-yield bonds. The fund is allowed to have between 20% to 55% in equities, up to 20% in money market funds, up to 10% in liquid alternatives, and up to 10% in commodities. The fund is allowed to have up to 60% in emerging markets, equities, and bonds. Now, while the limitations look quite broad, if we just consider taking the meat of the fixed income and equities range and put the residual in the next largest component, that is money market funds, that will give us roughly a 60% fixed income, 40% equities asset allocation model. There is no currency constraints on the underlying investments, although investors should note the base currency of the fund is US dollars. So all performance measurements should be using US dollars as a starting point. The fund also uses derivatives only for hedging purposes. Therefore, unlike some income-focused funds in the market, there will be no covered call options or equity-linked notes, etc., as a means to generate income or returns. There is no benchmark defined for the fund, which makes it a bit troublesome to assess the fund's performance. However, as mentioned earlier, the asset allocation appears to be aligned to a 60% fixed income, 40% equities model, so we can consider using that as a guideline if we need to do performance comparisons later. I also think Standard Chartered could have either thrown in a 60-40 model benchmark or provide an income target benchmark such as SOFR plus X% to make it easier for investors to understand if the fund is doing good or bad. The next section in the prospectus talks about the management process, which is essentially what I covered earlier when I explained what the Signature CIO funds are all about. Here it says the fund combines top-down macroeconomic views with bottom-up funds and ETF selection. However, as explained, this is done by two separate teams, and the top-down asset allocation takes priority over the underlying investment selection. This is evidenced by the next paragraph that says the key pillar and starting point is the SAA. This then follows by enhancement through TAA and underlying investment selection. Do take note here that it is mentioned the SAA is responsible for the portfolio's beta returns, while TAA and security selection are responsible for alpha returns, as I will talk about this again when we cover fund performance later. This follows with a paragraph stating that the Standard Chartered teams will have regular investment meetings with Amundi to exchange information and discuss ideas and so on. Given the Signature CIO funds are in fact Standard Chartered's standardized discretionary portfolio solutions, the reality should be that the Standard Chartered teams only need to pass instructions on portfolio changes such as buy X amount of Fund A and sell Y amount of Fund B on a daily basis to Amundi to act on. There should be hardly any reason for Amundi to reject the instructions, unless it is operationally not feasible. For example, having to sell a holding on a business holiday. The main reason why this paragraph has to be here is because, as I mentioned, this is really an Amundi fund, and Amundi bears full legal and regulatory responsibility for the fund if something goes wrong or if an investor makes a complaint to the regulator. If that happens, how Standard Chartered and Amundi resolve the problem will be behind the scenes. Then finally, there is a paragraph on sustainability and ESG, as this has become somewhat a necessary marketing fluff in all fund prospectuses. Here it says the sub-fund integrates sustainability factors in its investment process, but then says it does not integrate a consideration of environmentally sustainable economic activities into the investment process. Go figure whatever this means, because I don't think whatever the fund is doing or not doing with regards to this paragraph has any meaningful impact to the fund at all. All those investment strategy and process translates to the portfolio seen here, extracted from the April 2025 fund fact sheet. Broad asset allocation wise, it is split into fixed income, equities, hybrids, and cash equivalents. However, when we look at hybrids breakdown, it really consists of sub-financials, which are really complex bonds like AT1s and COCOs, and also covered call strategy, which is really equity options. So if we add this back into the main categories, we get a 40% equities, 58.3% bonds, 1.6% cash allocation that can be further simplified into the 40% equities, 60% bonds high-level asset allocation that I mentioned earlier. There is also a pie chart showing the portfolio is constructed with about 41% funds and 59% ETFs. Now this data will only be meaningful if there is performance attribution, showing using funds instead of ETFs have added returns. Otherwise, it doesn't make much sense to pick funds over ETFs, right? The fixed income breakdown shows further segregation of sub-asset classes, and I think this part is overcomplicated. Is it really important to separate EM US dollar government bonds and EM local currency government bonds? Why are there two different rows of DM IG government bonds? Why doesn't Asia US dollar bonds get split into investment grade versus high yield? Maybe Standard Chartered need a rethink on how to present this better. The equity breakdown is a completely different problem. Most mutual funds will show country breakdown and sector breakdown, but in this case, all we see is a big chunk of global high dividend equities. There is also global equity, but does that mean it is excluding the high dividend stocks? REITs and infrastructure have also been specifically separated when they are not even proper sector classifications. So I think this breakdown data are not really useful and brings about more questions from investors. Strangely, the fund webpage has a different way of presenting asset class breakdown. I have no idea why Standard Chartered cannot make things consistent in its webpage and fact sheet. The webpage also provides geography and sector breakdown, which I assume is for the equity exposure only. But without any descriptions to clarify and given these are not in the fact sheet, I will not discuss this data. A somewhat saving grace is that the fund fact sheet provides the full portfolio holdings information for investors to try figure out things themselves. Here is the first half that shows the holdings under fixed income asset class. With more information to study, there is of course more questions we can raise. For example, is there a need to have BlackRock BGF Global High Yield Bond Fund, an active mutual fund, and iShares Global High Yield Corporate Bond ETF, a passive ETF, at the same time to cover high yield bond exposure? Or that why is PIMCO GIS Income Fund parked under DMIG Corporate Bonds when it is a global diversified bond fund and actually has very little IG corporate bonds? And why also is Principal Finister Unconstrained EM Fixed Income Fund parked under EM US dollar government bonds, when its strategy goes for both hard currency and local currency flexibly? The same goes with the equities asset class that contains multiple dividend-focused mutual funds and ETFs. Are there really benefits to have so many products with similar strategies? And how much actual overlaps are there if someone has the tools to do a look-through to study the actual underlying stock exposures? There is also an interesting opportunistic portfolio category at the bottom of the list. Now, there is no mention at all in the fund documents on having an opportunistic piece carved out from the portfolio, so I have no idea what this is. Maybe this is part of the tactical asset allocation, but I think it should have been just integrated into the main listing to avoid confusion. One last thing about this full holdings list is that we can see the Signature CIO funds are using institutional share classes for mutual funds holdings. That should normally be the cheapest fee share classes, and that Standard Chartered wouldn't receive trailers for these share classes. This is a common approach for DPM, so that banks only receive direct fees on the product from clients and not get any other indirect fees like trailers and so on. Now, the monthly fact sheet also provides commentaries talking about past months' performance and portfolio positioning going forward. There is quite a lot of referencing on various sub-asset classes, but I think something crucial is missing. Where is the SAA plus TAA information? With so much elaboration on the investment process, there is nowhere in the fund documents that allow an investor to understand what exactly are the SAA and TAA determined by the Standard Chartered CIO team. Let me give an example of what I think should be presented to investors instead. So here is a hypothetical example of what I think is more useful to investors. The SAA weights indicate the long-term allocation to each sub-asset class. Based on the Signature CIO approach, this should take a 7-year forward-looking view, which means this is the optimal allocation for the next 7 years, based on currently available market data and assumptions. The TAA weights indicate the adjusted allocations to each sub-asset class based on shorter-term views. Based on the Signature CIO approach, this should mean outlook for the next 6 to 12 months. Showing both SAA and TAA weights allow investors to easily understand the overweights and underweights due to shorter-term outlook and market assessment. There should be a default ETF designated for each sub-asset class. This would be the ETFs to invest in, assuming no product-specific inputs from the fund select team. Using these default ETFs, we can derive both the SAA and TAA performance for us to assess how good the CIO views are and whether the TAA has resulted in any additional returns on top of SAA. Any additional products beyond the default ETF are tactical investments. Any adjustments to the weights of the default ETFs relative to SAA weights are also tactical decisions. This would be the investment decisions made by the fund select team and translates directly to the actual performance of the product. We can then assess whether the product selection and allocation by the fund select team has resulted in any additional returns on top of TAA. Using the DM government bonds sub-asset class as an example, let's assume in the next 1 year the iShares Global Government Bond ETF returned 1%, while Lexor Core US TIPS ETF returned 0.5%. The SAA would have returned 5.0% and TAA would have returned 5.1% using the iShares ETF performance to multiply with the weights. This shows that overweighting in this sub-asset class has delivered additional returns. However, the actual products would have returned only 3.6%, which shows the tactical product selection wasn't satisfactory. This is a clear and easy way to show investors what has done well and what has gone wrong in the portfolio. However, I don't think Standard Chartered or any other banks offering DPM solutions would be so kind to present the data this way. Fund providers don't like to be so transparent, as it makes them more liable to perform harder and better, and there is currently no regulation to make them provide strategy and performance disclosures with such details. Ultimately, I do hope things will eventually get better for investors, and one of the reasons for me to do this video series is to help improve investors' education and knowledge in these things. Anyways, let's continue with the fund share classes. The retail share classes of the Signature CIO Income Fund is represented using alphabet A, and also a special SC Invest share class name. The SC Invest share class is catered for Standard Chartered's SC Invest marketing campaign and has its own version of fact sheet where the fund name is even labeled as SC Invest Income Fund. However, don't be confused by all this marketing fluff. This is still the same Signature CIO Income Fund, just sugar-coated with a more fancy look and feel. The U and S after the retail share class code refer to US dollars and Sing dollars respectively. The AS share classes are currency hedged, while the SC Invest S share classes are currency unhedged. The C means capitalization or accumulation class. The D means distribution class and comes with a MD, which means monthly distributing. Other retail currency classes include Aussie dollars, Euro, Sterling, Hong Kong dollars, CNH, Japanese yen, New Zealand dollars, Swiss franc, and Canadian dollars. Given this is meant to be Standard Chartered's standardized DPM product, it makes sense to provide a wide variety of currency classes to capture as many different client regions as possible. This is a pretty new product, as Standard Chartered only launched this in September 2022. The Sing Dollar hedged share classes were only launched in 2023, while the SC Invest Sing Dollar unhedged share classes were launched only in July 2024, meaning they have less than 1 year of track record. The fund has gathered over $960 million of AUM, which is the best out of the 4 Signature CIO funds. It is interesting they have decided to disclose individual share class AUM in the fact sheet as seen. From this, we can gather that Hong Kong dollar clients are the main retail investors in this fund, followed by Sing dollar clients and then US dollar clients. We can also see here that the SC Invest currency unhedged share classes have not gathered much client interest so far. The retail A and SC Invest share classes have a 0.95% management fee. However, the other expenses appears to be quite high, as the total expense ratio across the share classes can range around 1.59% to 1.76%. It should be noted that some of the share classes with very low AUM will tend to have higher TER, as there are fixed amount charges in other expenses, so TER will get lower as the share class gets more AUM. The PHS states that 63.2% of the management fee is paid to Standard Chartered, meaning the 0.95% management fee is split into 0.35% for Amundi and 0.6% for Standard Chartered. Standard Chartered is allowed to charge up to 5% subscription fees for these share classes, although the SC Invest webpage indicates a limited time waiver on the subscription fees for the SC Invest share classes currently. In any case, I think anything more than 2% is excessive for mutual funds. The fund fact sheet provides the annualized distribution yields of each share class, which is good. The US dollar class currently distributes 6.2%, which looks in line with multi-asset income funds in the market. But we'll see later if the fund can generate enough returns to support this. The Sing Dollar Hedge class distributes 5.69%, which means the currency hedging cost is factored into the distribution yield. The SC Invest Sing Dollar Unhedged class distributes 6.28%, which should be designed to be similar to the numbers of the US dollar class. Strangely, the share class web pages provide very different data. The US dollar class and Sing Dollar Hedge class are both showing around 6% distribution yield, while the SC Invest Sing Dollar class is not showing any numbers. I suspect the fact sheet is more reliable in this. Hopefully, Standard Chartered can fix this anomaly. As earlier mentioned, the Signature CIO Income Fund was only incepted in September 2022 for its earliest share class, and therefore has less than 3 years of track record currently. The fund fact sheet provides the usual calendar year returns and annualized returns over various time periods. The lack of a benchmark, however, makes it difficult to assess whether the fund is doing well or not. To avoid confusion, it should be noted that the cumulative returns table data are not annualized. It is also worthwhile to note the 2-year annualized returns appears to be slightly above the distribution yield. So at least the fund is generating enough returns to pay out income without sacrificing NAV. The fact sheet also provides additional info such as best and worst month and maximum drawdown, which is not found in some mutual funds. The fact sheet also has a share class summary table that includes the performance data of each share class. While this looks useful at a glance, it should be noted that the SC Invest share classes are not found here, as they have a different fact sheet template. The share class webpage contains slightly different information though. There is a dynamic chart, but it took me a while to figure out the line represents total return, as there are no chart titles or descriptions, and the NAV at the top has no relation with the chart. The chart only allows selection of a few fixed time periods, and the mouse over data point simply shows a number from base 10,000. So what is really the purpose of this chart? I find this completely useless. This follows a performance section and a historical prices section. However, a lot of data looks misplaced. Hopefully Standard Chartered can fix these problems. There is also a risk section that contains volatility and Sharpe ratio data. Interestingly, there is a alpha and beta, but with no data available. Remembering the investment process in the prospectus talk about SAA giving beta returns while TAA and security selection giving alpha returns. It would be great if Standard Chartered can actually connect these dots and provide actual relevant performance data based on what they claim their processes do. In any case, let's first look at the performances between the share classes. Here is a comparison of the US dollar class, Sing Dollar Hedge class, and SC Invest Sing Dollar Unhedged class. Time period is slightly less than 1 year, as the SC Invest class was only incepted in July 2024. What we can see here is that for this time period, US dollar class delivered 4.96%, while Sing Dollar Hedge class delivered 2.99%. So there is roughly a 2% currency hedging cost in the past 1 year. The SC Invest Sing Dollar Unhedged class delivered only 0.67%, and it can be seen that the performance gaps against the other two share classes can be quite big at times. Now given the base currency of the fund is US dollars, The SC Invest class essentially requires investors to take on an active FX risk between US dollars and Sing dollars pair. As such, if you do not want to take on the FX risk, skip the SC Invest class and go for the A US dollar or A Sing dollar classes instead. Now, if we put SC Invest class aside, we can get a slightly longer track record of over 2 years with the A US dollar and A Sing dollar classes. Given the Signature CIO Income Fund is an income-focused strategy, my usual approach is to throw in the most popular bond fund in the market as a start for comparisons. So here we have PIMCO GIS Income Fund, with both its retail E-US dollars and Sing dollars hedge share classes added into the chart. Interestingly, if we compare the same currency classes, both funds delivered about the same returns in 2023, and PIMCO GIS income only lagged behind slightly from 2024 till date. Now, PIMCO GIS income currently also has around 6% distribution yield, so there is not much of a difference in that objective. What we should note, however, is that Signature CIO Income Fund is a multi-asset fund with around 40% equities and 60% bonds allocation, while PIMCO GIS Income Fund is a pure global diversified bond fund. Therefore, the main question here is that, is Signature CIO Income Fund giving enough additional returns for the investor to take on the additional equity risk? Based on the current performance against PIMCO GIS income, I would say no, that's not enough at all. Then, what should we expect? I added here the Amundi Index MSCI World Fund to represent global equity returns. We can then use the returns of Amundi and PIMCO funds to simulate what a 40% equities plus 60% bonds allocation should deliver via these two funds. This outcome is clearly a big gap above the current performance of the Signature CIO Income Fund. So, is the Signature CIO Income Fund giving this lower return because of the SAA defined is not optimal? Or is it because the CIO team has taken some wrong short-term views in the TAA given fast-changing geopolitical situations currently? Or is it because the fund select team has some poor performing funds in their choice of implementation? As mentioned earlier, these are not transparent to us, so we unfortunately will not have the answer. Regardless, the fund can and need to deliver much better performance going forward. Now, at this point, some loyal Standard Chartered supporters may violently object these findings and claim that the other global multi-asset income solutions are generating similar returns. So, here we go. A Sing dollar hedge class comparison chart with 3 popular global multi-asset income funds in the industry from BlackRock, Schroders, and Fidelity. What we can see here is that Signature CIO Income Fund has quite consistently stayed in the 3rd place among the 4 funds. So even with peer comparisons, it needs to improve on its performance. But again, I have already shown that a better performing solution can be easily created with 2 readily available retail mutual funds, and there are probably other better solutions out there. So why settle with this? With that, let's summarize our findings. The Signature CIO Funds is the outcome of a partnership between Standard Chartered and Amundi to deliver Standard Chartered's discretionary portfolio solutions in a mutual fund format, making it easier for more clients to access the solutions. The investment strategy and process are clearly stated in the fund documents, from strategic asset allocation to tactical asset allocation and to underlying fund and ETF selection. The roles of Amundi and various teams within Standard Chartered are also defined so that investors are aware of the involvement of the different teams in the fund. There is, however, no benchmark defined for the fund, which should have been rather easy to do so. While the fund states generating regular income as a primary objective, there is also no clear specification on the expected amount of income to deliver, which should also have been very possible to do so. There is hardly any information on the various teams involved in the fund. It would be good to provide some disclosure and to put forward some faces for investors to associate with the fund. There are multiple dislocations in the data and information provided in the fund share class web pages versus the fund fact sheets. Standard Chartered need to clean this up to make the information more consistent and reliable. The lack of breakdown on the SAA versus TAA versus underlying holdings in terms of their impact on the portfolio construct and the fund's performance is my disappointment on the fund and the DPM industry as a whole. I hope more can be done in information disclosure to investors in this area. The fund has a short track record of less than 3 years. With the limited track record so far, performance has only been average when compared to peers. It is very possible to improve the performance and certainly should be addressed urgently by Standard Chartered in order to make this fund a more viable consideration for investors. In conclusion, I think the Signature CIO Income Fund needs to establish better performance track record before it is worth taking a look again. This concludes my absolutely biased comments on the Signature CIO Income Fund from Standard Chartered. Again, if you find this video useful and would like to see more related contents, please subscribe to my channel. Thank you and have a great day.